You can see these things in hindsight, but when the Fed embarks on a rate cutting cycle, when they are about halfway through, silver starts to take off. And in the last 3 rate cutting cycles, silver was up over 300%. This is something that I started to address a little over a year ago. As we know, silver first sold off, corrected really hard at the beginning of the COVID pandemic. So in sort of March of 2020, went from about $16 to $20 and then rallied like crazy up until right into August where it hit $30. And then since say August of 2020, it's been in this range. I'm going to say anywhere from about say 22 to 28, $30. And then we broke through that last year in October. It rallied to about $35, had pulled back. We recently touched $35 again, just a matter of a few weeks back. And we've had a pullback again in recent weeks, again, on the back of, I think, this tariff news. So when I started looking at why silver would be trading with sort of a cap or a ceiling on its price when you've got these structural deficits that have been ongoing for the last 4 years consistently. Supply is about 1 billion ounces a year. So about 850 million ounces of that, or 85%, comes from mining, and the other 15% roughly comes from recycling. But supply is about 1 billion ounces a year. And yet for the last 4 years, on average, demand has been about 1.2 billion ounces per year. So we're looking at a 20% deficit every year for the last 4 years. And yet, if you're looking at this market, you ask yourself, how could the silver price seem to be capped at, say, $32 or so with ongoing structural deficits? Then I started looking at where are what we call secondary above ground silver supplies. And you have large inventories that sit on mostly 3 large exchanges: the Shanghai Futures Exchange, the LBMA in London, and then the COMEX in New York. And the LBMA is certainly by far the largest of the 3. What has happened is, and I started to do the research, look at the charts, and in about early 2021, we started to see, first gradually and then much more quickly, the inventories at these exchanges drop off. I asked myself, okay, so what was going on? These are the kinds of things that you have to make assumptions about. But for me, the most logical explanation for that was that you had consumption and demand of silver continue to go up and stay up consistently high. So for me, the conclusion was that you had large industrial consumers mostly, and a lot of that driven by the demand from solar, requiring physical silver. So they would be able to go buy a long futures contract, meaning a contract where you expect the price to go up. And when that contract matured, they would go to the exchange and say, okay, my contract is now up. I would like to take delivery. Now, the Shanghai is built for that kind of mechanism, but the other 2, the LBMA and the COMEX, are not built for that. They were not meant for that. They were just meant for hedging and so on with futures contracts. Well, lo and behold, as I say, if you look back from about early 2021, inventories have come down, depending on which exchange, to the tune of 40 to 70%. I came to the conclusion that what that meant was you could have large consumption of silver being met by going to these exchanges, taking delivery of physical silver, because you had these stockpiles of silver, so they could draw down on already stockpiled silver without having to put pressure on bringing new additional supply to market from mining or from recycling. Well, after I expressed my conclusions about what was going on and why this may be limiting temporarily the upside on the silver price, there was a fantastic report by TD Securities almost 30 or 40 days later that said essentially the same thing. And they were saying that they had the conclusion I had, which was that this could go on for about maybe 12 or 18 months at the current pace. And after that, we really would dry up this secondary supply of silver. Basically, the large consumers would start to put a lot of upward pressure on the silver price because they wouldn't be able to meet those demands from existing above ground supply anymore. The pushback I get from when have these discussions with colleagues and other people in the industry is they'll say there's lots of other silver that's held above ground, and it's true. Silver and gold, a lot of it is held by private investors. They have their own stockpiles and so on. And so they'll say, well, if we get to that point, a lot of this additional silver, which we can't quantify. We can quantify what's on the exchanges, but we don't know how much silver really is held. We can make estimates. It's maybe a few billion ounces is held privately. And their argument is that this silver will come to market and it will meet some of that demand. And my counter argument is that yes, however, at what price? And so I don't believe that silver, which is very tightly held, will come to market at, say, prevailing prices. I think it'll come to market at much, much higher prices. And by that, I mean, $40, $45, $50 is what it's going to take to get some of these private holders of silver to let go and to sell it back into the market and to satisfy this demand that really is not being met any other way. So investors of physical silver will absolutely be competing with industrial consumers, and all of that will drive silver higher. I think what has been going on there is, for the most part, and this we've seen start to happen since November or so, and that was when Trump started talking about tariffs. And we had no idea what the tariffs would apply to, who they would apply to, etc. I believe what happened was you had participants in the market, in the US specifically, where if the tariffs were applied on imports, which is what we're talking about generally, imports to the US, that if they had to come up with a lot of silver and gold to meet deliveries, that they would have to do it at much higher prices because of potential tariffs. So I think that's the consensus, that really what has happened was we've seen these outsized flows of gold, of silver, come to New York mostly from London, some of it from China as well, to meet this potential demand in case tariffs got applied against silver. So, because that would have sunk plenty of institutions if they had to, from one day to the next, have to go out and buy silver and pay 25% more because of tariffs to meet a contract. Interestingly enough, especially in the case of gold, I believe that was a lot of the premium that got built in. So in other words, from let's say November until last week, both metals moved up considerably because the market thought this was a serious risk and it would take silver and gold at these higher prices to be able to meet that demand. Now, some of that risk has gone away. And we know from lists that were published from the White House, gold, silver, several other base metals and other things have been completely exempt from the tariffs. We've seen lease rates stay high on silver. We've seen EFP premiums, exchange for physical premiums, have stayed high. And so both of these things speak to serious tightness nonetheless in the silver market. I'll give you a small anecdote, and this is from already about a year ago. This was a mining executive who produces overseas, produces silver, only silver, and sells about half of their production to China and about half to the West. And he was telling me that the silver consumers would come to them and say, we are prepared to pay you up to $4 over spot. We are prepared to pay you 2 weeks in advance. We absolutely need to secure this supply of silver. And I believe a lot of that is destined for solar. As I say, it's anecdotal, but it certainly speaks to the kind of tightness that we've had in the market. And as these secondary inventories get whittled down, I think that we're going to see the silver price bump up. And think about, kind of what's happened over the past year. In February of last year, silver was about $22. And then very soon after, it started to rally very strongly. So from about February until October, it went from about $22 to $35. That was a 40% gain in a matter of about 7 months or so. And I think that was the market coming to terms with the fact that this secondary supply to meet serious ongoing demand and meet these structural deficits really could only go on so long. And we've certainly seen silver back off. It rallied again. It's backed off again. But I think that a floor somewhere in the maybe $28 US range is about where it's going to be. And I think it'll hold up quite strongly from there. If you look at maybe what has weighed on silver recently, besides, this